Hey everyone, it's Zach back with a new mortgage video. Hope you're all having a happy Wednesday. If this is your first time seeing one of my videos, welcome to my channel. If you're a returning viewer, welcome back, where I'll try to demystify all things mortgage related. If you find this content helpful, please like and subscribe. So I shot a video a little while back on assumable mortgages and talked generally about second loans that you could take out to bridge the gap between the sales price and the existing loan. If you haven't seen that video, I'll put a link below because that kind of sets the foundation of what I'm going to talk about today, which is specifically second loans on an assumable mortgage purchase. So first of all, if you are able to cover the gap between the existing loan and the sales price with cash, no need to watch this video. Just understand assumable mortgages and proceed. This is specifically for if you cannot or don't want to cover that gap and would like to get a second loan so you can have a lower down payment. Now, the first thing to understand is there is a loan limit for the combined loans of the existing and the new one. And that number is 90%. So let's say you have a property being sold for $500,000, the existing loan is $300,000. The maximum second loan you could take out is $150,000, meaning you would have to come up with $50,000 in that scenario, rather than if you're just assuming the loan, not getting a second, and you'd have to come up with $200,000. Now, another thing to know is that there is a minimum second loan amount, and it's $50,000. So same scenario, property being sold for $500,000, but let's say the first lien on the property is $440,000. That would only be a $10,000 loan amount between $440,000 and $450,000. We would not do a loan that small. And in that scenario, you're not paying that much more, $60,000 versus $50,000. So it would make sense to just cover the cash yourself. The other thing to understand with these type of loan scenarios is the blended rate. So when you're doing a traditional 30-year fixed mortgage, you've got one interest rate, 6.5%, let's just say. When you're doing one of these, you're talking about two mortgages, presumably a very low primary mortgage, let's say 3%, and then on the second loan, it's going to be a higher interest rate. So what you want to look at is what the combined interest rate is when you factor in those two loans. If that number is like 4.75%, that's a good bit lower than the market rate, and that would make sense. If it's similar or definitely the same as the market interest rate, that blended rate, then I would definitely just go with a regular mortgage and save yourself the hassle and the headaches of having to apply with this lender who's really not incentivized to move quickly. On that note, if you are going with this second loan option, a big thing to understand is that the existing lender has to agree to working with me or whoever the other lender is that's providing that second loan. So really that lender has all the power. Like, I'm still collecting your documents and making sure you qualify for this second loan, but ultimately I'm just shipping it off to this existing lender, and they're the ones that can say yes or no ultimately to whether they'll allow it. So like I said, with the assumable loans video, it's not quite as cut and dry a great strategy as many make it out to be, but certainly can be a good strategy if you understand it and you're getting a blended rate that's a good bit lower, and you're okay with the process taking longer than it would with a regular loan. As always, if you have any questions, feel free to comment below or call, text, or email me. But thanks for tuning into this video, and I'll see you next time.